Clearly a big gap up. We had an II last week here and here. And on Friday, we had a bear breakout below the II and did not get very far. And now we're getting a bull breakout. That rally over here was strong enough so that it was likely we would test the top of the rally, which is what we're doing now. 2 legs up, 1, pull back, 2, pull back, maybe 3. We're getting near the top of the 2-month trading range. For the bears, they have a double top lower high, and the bulls are trying to break above that double top lower high, but it's not that simple. We're still in the trading range, and even if we do break above this high, the bears will try to create a wedge lower high. The bulls want a bull breakout above the double top neckline. Bears want the measured move down, and the bulls want the measured move up. Now, how bullish is the gap up today? Well, we're near the top of the trading range, and we had 5 doji bars over here, and therefore this is less bullish than what it might otherwise be. Overnight, the market was sideways for a lot of hours, about 7-8 hours here. This is a 15-minute chart, but pretty bullish here. We have a 7 or 8 bar bull microchannel. Whenever there's a gap up, there's an increased chance of a trend day, and if the gap is big, the odds are higher, and the odds are slightly higher that the trend will be in the direction of the gap. So here we have a gap up. So if today's going to be a trend day, it's slightly more likely that it will be a bull trend day than a bear trend day. Don't need all of these lines. Breakout point there. I'll leave that in for the time being. We're already beyond a measured move up from yesterday's range, and a measured move up from the 3-day trading range is right there, which is that major lower high. That is the obvious magnet. All right, right now, even before this bar closes, it's a decent bull bar closing near its high. So even right now, there's probably a 25% chance that we've already seen the low of the day. And that is why some traders are just going ahead and buying. They're confident that even if we stall on bar 2 or 3, the math is still pretty good, betting that we're going to get the trend up. When we get these bars like this, where there's an increased chance of the very first bar of the day being the low of the day, at the time it happens, it never looks all that likely. But an hour or two from now, you look back and say, "Hey, wait a minute! It has not fallen below the low of that first bar." And a lot of traders will wait for a pullback and then take the buy. Okay, if you're going to get a big gap up in a bear day, usually the first bar or 2 is a bear bar, like that. And we don't have that here. A bear day, gap up bear. Gap up early bear bars. Gap up early bear bars prevented the bull trend day. We do not have that. And because so far, at least, 30 seconds left of the bar, but so far this is not a bear trend bar. The odds of it being a bear trend day are less. And then you have to look at bar 2. Sometimes the bear bar is on bar 2 and you get the bear trend day. If we do not have a strong bear bar on bar 1 or bar 2, the odds of this being a bear trend day are small. And that means that there is either going to be a trading range day or a bull trend day. Okay, very good bar for the bulls. All right. You can see we're testing that major lower high. And as soon as the bar closed, look at the low of bar 2 and the open of bar 2. It's at the close of bar 1. So that tells you that a lot of traders were waiting for 1 to close and then they just bought the market. Bar 2 is important. If we get a second consecutive bull bar, we could get a strong bull trend day. If we get a disappointing bar, which is what I think we'll get, then if we do have a bull trend day, it might be a smaller bull trend day like this over here. The reason why I think bar 2 will be disappointing is because of the daily chart. Trading range for a couple of months, and we're now near the top of the range. We sold off repeatedly around this price level, and now we're back up to that price level. This is similar to bar 20 yesterday. Let's say it's a bear bar closing on its low. It's a possible high of the day. But unless it's a pretty good bear bar, I think a lot of traders will not take the short. A lot of times you'll get a gap up and a rally on the open and then a deep pullback near the moving average. And then you got a double bottom or a wedge below flag. Here we had 8 consecutive bear bars, yet it still rallied from there. Here we had a couple of bear bars and we got a small double bottom and we rallied from there. Here, the first bar was a bear bar and then bad follow through bull bar, and we got 2 small legs down and then a rally. As you can tell, I'm not bearish. I think the market's probably either going to be sideways to up. Here, a big bear bar, but the absence of a bear trend. The bulls bought 2 legs down, 1 pullback, 2 near the moving average. This is what the bulls would like: a second very strong bull bar closing on its high, and then a rally from there. A lot of times if you get a gap up and an early rally for 5 or 10 bars, the market then goes sideways for several hours. This is a very common thing. So if we just go up very quickly, this is probably what we'll get. Less likely you get a bull leg that doesn't look all that strong. Weak follow through dojis, and then you get another breakout with weak follow through, but you have a gap. You have a gap this high, that low, and then a gap this high, that low. Whenever you have a weak rally and it's forming gaps, you got to be thinking that the day could be a small pullback bull trend and it could go up a long, long way. Trend from the open bull trend bar. Okay. Rallied for 5 or 10 bars sideways, and then we got some trend resumption up at the end of the day. When it got near the moving average, the bulls bought. Gap up, very strong pair of bull bars, high probability, low of the day, and at least a measured move up. Same thing here. Same thing here. Again, sometimes you get a gap up and then bad follow through and an attempt to sell off. When it gets near the moving average, you got to look for a buy. Here is a wedge. It's typically either a wedge or a double bottom. Very far above the moving average. And that's part of the problem with bar 2. A lot of the bulls are saying, wait a minute, this is way above the average price. Do I really want to be buying far above the average price? And a lot of bulls will say, no, not really. What happens if bar 2 has a bull body, but the bar is not all that big? Well, we're always in long, and that will not change things. It will reduce the chances of today being a huge bull trend day, but it does not change things. Right now, the odds are today is either going to be a bull trend day or mostly a trading range day, and the odds are against a bear trend day. Again, context is good on the daily chart. We tried to sell off below the II on Friday, and it failed, and now we're breaking above the II. So we have trapped bears. 30 seconds left, and the bar is not particularly big, so that reduces the chances that today is going to be a huge bull trend day. It's still 20 seconds left of the bar. It still could suddenly get very big in the final seconds. Buy the close 1, buy the close 2. breaking above that key price. Let me change this to pink for the gap. Can you sell here, betting that it's unlikely to go straight up? It is unlikely to go straight up, but the odds are it's either a bull trend or a trading range, and I think that makes it difficult to make money selling the close. So I would either be long or flat. I would not sell yet. If bar 3 is a big bear bar, you might sell, but chances are if it sells off, buyers will come in around the low of bar 1, and if it sells off for 5 or 10 bars, the moving average will be all the way up here, and it will be a double bottom around the moving average. Like this. Big gap up, rallied for a few bars, and sold off for about 8 bars near the low of bar 1 and double bottom at the moving average. So the two things are the low of bar 1 and the moving average. Both are support and both are therefore magnets. Still by the close, the bodies are obviously getting smaller. That increases the chances that we'll start to go sideways, but no sign of a top, and I think it's not worth shorting. Can bulls buy the low of bar 4, arguing it's a strong enough rally, big enough breakout so that there probably are buyers below 4? I would not, and let's say 4 closes on its low. It's theoretically the high of the day, so technically you could take the short, but the odds are against this being the high of the day without at least a micro double top. So probably the best the bears can get is either sideways or down to around the low of bar 1, which, as I said, would probably come around the moving average. Moving average is rising quickly. Every bar that gets added up here replaces a bar down here, and therefore the average price is getting pulled up. Moving average is getting pulled up pretty quickly. By the close bulls, shrinking bodies. We got the target. We broke above that high over here from a couple weeks ago. And are we going to continue straight up above that resistance level, or will the bulls take profits and bear scalpers sell? That's what we're finding out. If it's anything less than a perfect looking bear bar, I think a lot of the bears will not sell. However, if it has a bear body, especially a 2, 3, 4 tick bear body, a lot of the bulls will be disappointed and they'll try to get out around the 3 close, and we could get a micro double top and then a test down. Again, the target moving average maybe all the way down to the low of bar 1. If it's a disappointing bar, a lot of the bulls will get out below 4. Let's say 4 closes on or near its low. A lot of the bulls will exit. What about yesterday, Friday? We had that 8-bar bull micro channel. I said buyers below. Yes, we had an 8-bar bull micro channel. Here we have a 3. If you count these 5 bars from Friday, you could say it's an 8-bar bull micro channel. But today I would think of it more as a 3-bar bull micro channel. Final seconds, what are we going to get? Okay, a 1-tick bear body. Not enough to scare the bulls, and not enough to make the bears sell below 4. They might sell above 4, taking a chance that we'll get a micro double top. Maybe we'll rally and form a parabolic wedge top. But, it's not enough on the part of the bears to make traders believe we're going to go down very far over the next few bars. Still always in long, still by the close. Bears hoping for a parabolic wedge. So they don't mind a strong bull trend as long as it has 3 pushes up, and then we get a reversal down. Strong bull trend as long as you have 3 or 4. 1, 2, 3, 4, 5, maybe 1, 2, 3. Different computers count it differently, but the bulls are looking for, the bears are hoping that whatever rally we get has three legs up, some way to measure 3 legs up. And bulls, they don't care if it's 3 legs up. They know that at least half of the time, if the bears get a reversal, you're going to get at least 1 more leg up. So wedge top, an attempt at a parabolic wedge, got at least 1 more leg up. Parabolic wedge top, went sideways for many hours, and then got some trend resumption up at the end of the day. What do you do here? Well, it's still always in long. The risk of a big sell-off is small. The stop for the bulls is below 1. If it falls below 1 and the bulls get stopped out, they will buy again on a reversal up. What are the chances that today will be a bear trend day? At this moment, probably 20%. And the decision, I think, is between a trading range day and a bull trend day. Can bull scalpers buy 4 low or 4 high? I wouldn't do it for a scalp. If you're doing it for a scalp, you're going to be scaling in, stop below 1, so you're risking about 7 points or so. And swing traders, if they're buying for any reason, the stop is all the way down below 1. Remember, a lot of bulls, as soon as they saw 1 close, they bought the 1 close. And therefore, the 1 close is support. If the market gets back down there, a lot of the bulls who bought the 1 close will buy again. If it falls strongly, 3, 4, 5 ticks below that 1 close, it'll increase the chances that we're going down to the 1 low. High 1, buy. Is there any way to construct a parabolic wedge out of this right now? No, I think most computers would say bar 3 is leg 1, and then bar 6 would then be leg 2, so we still probably need a 3rd push up. We might get this. So here's 2 legs up, right? 1 pullback, 2 bull bar closing on its high. We got 1 more bull bar, and then we got a 2-legged pullback to the moving average. So we might be doing this, but the odds of a parabolic wedge reversal at this point are not very high. What are the chances that 6 could be the high of the day? Right now, I would say 20% chance. Let's say 6 has a 5-tick bear body closing on its low. Then maybe a 30% chance. But more likely, the best the bears will get is sideways to down to around the moving average. And even with this big bear bar, the bull still saw it as 2 legs down, 1 pullback, 2, and a double bottom with this and low of the day. So if we get a couple legs down to the moving average, the bulls will buy a reversal up. Now we have a 6-bar bull micro channel. Can you buy at the low of 6? If it closes on its low or only has a 1-tick tail on the bottom, I would wait to buy. As far as bears go, can they sell betting it'll go down far enough for a scalp? It might, but I still think it's better to look to buy a pullback than to sell the reversal. 7-bar bull micro channel, probably buyers below. And now you can see a 3rd push up, We had 3 pushes up, 1, 2, 3, first push, then 5, and then 7. So a small parabolic wedge. But I think a lot of bears will not sell below 6 or 7. It's a 6-bar bull microchannel. They'll wait for a second entry short. Here we have a first reversal, second reversal, third reversal. Here we had a reversal down, and looks like a small reversal down here and a second reversal here. Here we had a pullback, and then we had about a 10-bar bull microchannel, and they bought the low, and the bears had to get at least a double top before they could get more of a correction. So the risk of a reversal on the first reversal down is small. Closed bulls 1 now can take partial profits at 4 points. Other bulls are trying to get a breakout here and a measured move up. Again, bears are not making money. It's too early to sell. The bears will try to get a parabolic wedge top. Remember, as I said, if you get a rally that lasts about an hour or so on the open, usually the market ends up going sideways for several hours. So this looks like one of those too fast days. So it looks like we're probably going to go sideways. The bears hope that we're getting a parabolic wedge top and a reversal down and a bear trend day. More likely, the best the bears will get is some kind of a trading range over the next hour or so, like this. Again, moving average, bulls will probably buy around the moving average. Even if the bears do get a successful reversal day, usually it has to go mostly sideways for an hour or more. So the risk of a downside move is small for the next hour or more. Bulls trying to get a breakout and bears trying to get a parabolic wedge. 3 pushes up, 3, 5, and then 7. It's still always in long. And right now, 9-bar bull microchannel. Small chance that we'll just sell off from here. The best the bears probably can get is a bull flag. This is a bull flag. We got a bear breakout of the bull flag, but it was a bear channel lasting 10 or more bars, pulling back to the moving average. It's a bull flag. Odds are it's going higher, but the more bars that get added, eventually the bears have about a 40 or 50% chance of a bear breakout if you add a lot of bars to it. This is slightly more likely. Look at this. You bounced a couple bars here and bounced a couple bars here, right? If you get that, it increases the chances that you're going to get trend resumption up. If you do not get much of a bounce, it reduces the chances that you'll go up and increases the chances that you go more sideways and maybe get the bear breakout. Okay, the bears were unable to close 8 below its midpoint. Some profit takers, 4-point bulls who bought the 1 close. Very often when you get a pair of strong trend bars on the open, you get a measured move. Here we got 3. Is bar 3 a strong trend bar? I don't know. To me, the measured move would probably be based upon 1 and 2. 3 is the tail's too prominent compared to the size of the body on 3, so to me that would be a reasonable target for the measured move. Just look at the past 5 or 6 bars. Right, smaller bars, bear bodies, tails. Right, trading range look to them, and it could be warning us that we're going to start to do this soon. Much stronger open than what we have today. The second bar is even stronger than the first. But this is what we might start to do. This is what I think we're going to start to do. And the bear's hoping that it's an endless pullback. Let me turn off the screen for a second. Microsoft is complaining. Looks like a sync problem with my 2 computers. If it's going to start to turn into a trading range soon, what about selling at the highs, selling the bar 8 high? I still think it's too early to sell. Bears have not made a penny yet today. And I think unless you see bears making money with limit orders, it's not worth selling. So either you're buying or you're waiting. Still a breakout, 7, 8, and now a gap, 9 low and 6 high. Unlikely to lead to a measured move up. It might lead to a measured move up from that, right, to the start of this, two-sided trading, right? That would also correspond to the measured move based upon the open of the first bar of the breakout to the close of the final bar of the breakout. Again, I think 3 is the beginning of the channel. I think the breakout is 1, 2. Probably profit takers here at that measured move. And we'll probably start to go sideways there. Bears trying to close the gap, 6 high. But even if they do, not a lot of downside risk. This is the first pullback in 9 bars. Probably buyers at the 7 low. And then we have the buy climax, 7, 8, buyers at the 9 low. And then we have the buy climax, 7, 8 buyers there as well. And if we do start to go down, we'll probably not go down very far before we start to go sideways. And then buyers when the moving average gets up there. A very low probability short. What happens if we get 3 or 4 consecutive bear bars? Then we'll probably get a couple legs sideways to down. But right now the odds are the best the bears will get is a sideways to down move for the next hour or so. I doubt we'll get this. We're at 1, 2, 3 pullbacks before we could get that. This is probably the best the bears can get, sideways to down to the moving average. Bulls who bought the 9 low probably would put a stop a couple ticks below 4. Will they swing or scalp? Well, you can always swing, but I think the odds are we're going to start to go sideways soon. and therefore a lot of the bulls might start to scalp and look to buy pullbacks. Because we had a pullback, will bears start to sell above bars, especially around that measured move? I think it's probably, I don't know, I think it's probably not a great thing to do, but I do think the odds are we're going to start to go sideways soon. Small chance the gap is from the one low, and we go all the way up. That's the all-time high. You can see a lot of the bulls who bought the 9 low scalped. It's a high one above 10, but because of the loss of momentum, a lot of bulls want to buy pullbacks and not breakouts. And they're scalping out of longs above 10, especially since we're close to a measured move target. Limit order bears trying to make their first money of the day. Bears selling the 10 high below the measured move target. Again, I think it's probably not worth doing that yet, but there are bears that are doing it. Bears need one more tick. They sell the 10 high, they look to scalp out. They need it to fall 5 ticks, and so far it's fallen 4. The market, the bears are trying to transition the market from a bull trend into a trading range. They know it's unlikely that they can transform it into a bear trend until after we have at least a 10-bar bull flag, 10 bars sideways to down, like this. Fell 5 ticks, so the bears made money for the first time today, and that will make them more willing to sell, initially with limit orders above bars. This is probably what we're beginning. You can call it a high 1 or high 2 with bar 10, but probably not much up from here. We're probably entering a tight range. We're always in long, but this is probably what we're doing here. Because the range is probably going to be very tight for the next hour, it makes it difficult to make money. Still always in long, probably sideways to down to the moving average over the next 5 or 10 bars. You can see the moving average is now back above the low of the day. And you can also see that this is starting to look like that and that. What are the chances that we suddenly reverse? Small. I give some examples. Sometimes you get that, but even then it becomes big up, big down, big up, big down, big confusion, and this is probably what's going to follow. Are we always in short yet? No, but this is different from those gentle pullbacks. It's more like this. So we may be getting a big up, big down, and trading range. Probably buyers around the moving average, just like this. It fell below the moving average, but the moving average provided support. So big up, big down, and then trading range the rest of the day. Can the bears get a big bar, bigger than what it is right now? Can it close on its low? Can they get follow through on the next bar? Chances are the bears cannot accomplish all of that, and therefore this is probably more likely going to result in a trading range. The bulls have a small breakout, 7, 8, and then 14 is reversing that bull breakout. Most reversals result in trading ranges, not opposite trends. Surprise bar 14, and therefore we'll probably have at least a small second leg sideways to down. So a lot of bulls will wait to see that second leg. If we get a bad follow through bar, I had one example of that. No, I'm not finding it. Here, bear breakout, bad follow through, and then we rallied for the remainder of the day, got down to the moving average. So leg 1 pullback, leg 2 bear breakout, bad follow through. Leg 1 pullback, leg 2, and the bears need good follow through. We're still very far above the moving average, and in this example we got to the moving average. Remember, I said we have big gap up days with rallies, usually buyers around the moving average. So here, not only did the bulls get bad follow through after the bear bar, they created a bull bar after the bear bar. It was also at the moving average. Right now we're still far above the moving average. So a lot of the bulls are less eager to buy. They want to buy at an average price, not far above the average price. And to get to the average price, probably more sideways than down. $14, big enough bar for a surprise, and that increases the chances that we'll get at least a small second leg down from here, especially since we're not at important support. We're at the buy climax low, 7 low, so there's some support there. But more important is the moving average, and more important is that major lower high from a couple of weeks ago. Let me just look at this from a leg 1, leg 2 perspective. So let's say this is leg 1, maybe that's leg 1. We're beyond leg 2. What happens if we get a bull inside bar like this? 2 legs down, 1 pullback 2, and a bull inside bar. Well, some bulls will buy, some will wait until we get 3 or 4 bull bars and then they'll buy. My concern about this is that we're too far above the average price, and therefore I think we're probably going sideways to down more. I'm not going to buy above 15 because we're too far above the average price. You can see the bulls trying hard to get at least a 1-tick bull body to create the high 2 buy and the failed bear breakout. But I think it doesn't matter. I think the odds are we're going to get down to the moving average either by going sideways or down. And therefore, it's probably a little early to buy. Bear body, but still always in long. However, as I said, I think the bulls would rather buy closer to the average price. Picture getting confused. Confusion usually means trading range. A lot of traders will sell the 10 high, maybe the 12 high, but far fewer traders will sell the 15 high, too low down. And if it's going to be a trading range, you want to sell high, not low. However, it's big enough down to make bulls want other reasons to buy in addition to the high two. They have a high two 12 and 15, but they have a bear body 15. We have a surprise bar 14, so probably second leg sideways to down. And we're not down to the breakout point, the red line. We're not down to the bottom of the channel, the 4 low, and we're not down to the moving average. So a lot of bulls want the market to go sideways to down more before they buy. You can see here, after 3 or 4 bull bars, bulls started getting more confident and we got a rally. So bear breakout, bull follow through. Today, bear breakout, bear follow through, although we're getting bull follow through on the second bar. Sometimes you get the bad follow through after the bear breakout on the second bar instead of the first bar. So this is still a failed breakout and still a high two, but we're not quite down to any of the support levels, the breakout point, the bottom of the channel, or the moving average. Makes it likely that there'll be sellers somewhere above 16, maybe up at the 14 sell climax high. Trading range likely. Top of the range, maybe the 14 high, maybe the high of the day. Bottom of the range, probably around the moving average. Here, after we went sideways for about 10 bars or so. I think the odds are against this today. I think more likely it's going to be trading range, maybe for the rest of the day. Like this. Here the bears were much stronger than today, but they still, the market still went sideways pretty much the rest of the day. Bears still have a gap 12 low, but I don't think it matters. I think trading range is most likely. Really nothing to do here. The bears want to sell higher near the 14 high, and the bulls want to buy lower at the moving average. I think we're going to go to the moving average either by going sideways or down. The measured move from that gap 14 is not all that far down. So here's the top of the sell-off. Here's the gap. We tested the gap, and the target is the breakout point and the bottom of the channel. And if we go sideways for a few more bars, the moving average will be up to that same price. And therefore, there will be a cluster of support things at the same price, and bulls will probably buy there. And will they buy for a scalp or a swing? We're still always in long, but look at the bars. Look at the past 10 bars. A lot of 3, 4 tick talls bars, 1 tick bodies. Probably not going to go very far for the next hour or two. The bulls here have a double bottom, but look how small everything is. All right, so you have a double bottom. If you break above the neckline, here's the neckline, so double bottom here, neckline, measured move up is the top of the sell climax, the 14 high, and bears probably will sell around there, betting that our trading range is more likely than a resumption of the bull trend. Getting close to the moving average. Probably we'll get a small second leg down from this. So leg one, ABC pullback, and then leg two, and then the bulls will see it as a wedge bull flag near the moving average. I think a lot of bulls will wait for it to actually touch the moving average. Here we fell through the average price. Here we touched the moving average, but did not get a bounce. I still think we've entered a trading range. Remember I said sometimes when you get a gap up and it rallies for about an hour, it goes sideways for several hours. I think that is what we're getting here. Like this. Like that. Bears trying to get a breakout, try to get a breakout, try to get a breakout. Bulls try to get a breakout, try to get a breakout. And everyone keeps betting on the trading range. They buy the bear breakouts, they sell the bull breakouts. Same thing. This is a much stronger bull trend, but still went sideways for several hours. This is even a much stronger bull trend than what we have today. Sideways for the remainder of the day. It pulled back. We'll get about an hour rally and then sideways for the remainder of the day. I don't know that we're going to stay sideways for the rest of the day, but the odds are we're going to be sideways for at least another 2 or 3 hours, and the market is deciding where the bottom of the range will be. Is it the 16 low? Is it the moving average? Right now, I would say 70% chance we've seen the low of the day. Bar 18, once you have the first hour and a half in, and let's say you get a breakout above 11, 90% chance you will not fall below 1. Let's say instead we break below 1, then 90% chance we will not get up to a new high of the day. Right now, there's a 90% chance we've seen either the high or low of the day. And it's obviously more likely that we've seen the low of the day. So probably right now, 70% chance we've seen the low of the day. What about stop order bears for a lower high? I would not. I think if you're selling above bars, you're selling above 17, you're selling the bull close 22. Let me zoom in on this. The buy the close bulls who bought the 14 bear close needed 5 ticks. They got 4 ticks. The stop order bulls who bought above 16 did not make money. The high 2 bulls above 19 did not make money. The bulls who bought the 17 low did not make money. So it's interesting. There are several reasonable buy setups, but and we're always in long, but the bulls are not making money. The bears who sold the bull close 23 have not yet made money. The bulls who sold the 12 low have not yet made money. The range is very, very tight, but that's what traders are doing. They're selling above bars, selling bull closes at the top, buying below bars, buying bear closes near the bottom, and using wide stops and scalping. I still think we have to get down to the moving average, and therefore I think a lot of the bulls are not willing to buy yet. That's the close of the second hour. 60-minute chart, we have a breakout, but weak follow through. 3 pushes up, 1, pull back 2, pull back 3. So we have a potential wedge, 1, 2, 3. Right now it would be a wedge lower high major trend reversal. I don't think it matters whether or not we go to a new all-time high. If we get a new all-time high, it would be a wedge higher high major trend reversal and an expanding triangle top. Up, down, more down, more up. Traders are selling above bars. They sold above here and they scaled in higher. They sold above here, scaled in higher, and they will sell above here and scale in higher, betting that we will not form a gap. Here's a gap, this low, this high, that low. So the bears who sold here got trapped out. They added on higher and they could avoid a loss, but they did not make money. And the bears will sell either at this high or higher, or at this high and scale in, and they probably will make money. 5-minute chart, still always in long, but we're getting fairly close to the moving average, and traders know the odds are we're going to get down to the moving average, and therefore a lot of the bulls are hesitant to buy. If we start to break strongly to the upside, they'll buy, but they know it's more likely that we're going to stay sideways and get down to the moving average. Remember I told you those parabolic wedge tops sometimes have pullbacks that last about an hour or so, but more than half the time, instead of getting a bear breakout, you get a bull breakout. Here, you can see we got the bull breakout, but we touched the moving average. Here's another failed reversal attempt, but it had to touch the moving average before the bulls bought again. It ultimately failed, but the bulls did not buy strongly until we got down to the moving average. Here, had to get down to the moving average. Bulls reversing 14. We have a inside bar on the 60-minute chart, so a high one buy, but not a very good looking buy signal bar. We're in the sell zone, right? The bulls want a breakout above 14 and a measured move up, and the bears want a double top with the 14 high. We're one tick above the 14 high right now. If we get 2 or 3 ticks above, it increases. Oh, we didn't get above. We're right at. If it gets 2 or 3 ticks above, it increases the chances that we've begun a swing up. If it only gets to the 13 high or 1 tick above, it increases the chances that the trading range will continue. Okay, 13 high is the high of the last hour, and that triggers the buy signal on the 60-minute chart. And this is therefore the entry bar. Suppose we got 2 or 3 consecutive bull bars. Well, it probably would become buy the close again, but outside of bar 1 and 2, this is our day, right? Will bulls eagerly buy at a new high, or will they take profits, betting that it's more of a trading range? Well, they'll probably take profits, so the odds are against a strong breakout from here. Sometimes you'll get 1 or 2 big bars, but I think the odds are against a big bull trend from here. We've only had 2 strong bull bars and then 20 trading range bars, so chances are more likely it's going to remain mostly a trading range. You can see this is not nearly as strong as that, but parabolic wedge top, tried to reverse down, broke out, but limited up. We got a good breakout here, a second breakout here, but not much up. And I think this will probably be the extent of the breakout, a bar 2 or 3, and then sideways. Less likely we're going to do this. Here we had no sideways trading. Today we have a tight trading range lasting 20 bars. Here we don't have that, and we're able to break out strongly and continue up. This is probably more like what we'll get today, just a breakout for a bar or 2, and then not much follow through. Gap up sideways for an hour or 2 and then trend up, but got down to the moving average. Got down to the moving average. Got down near the moving average. got to the moving average. Here we rallied for 2.5 hours, but we did not have a 2 hour or an hour trading range along the way. Here we had a trading range, got to the moving average. Here, not really, you can call it a trading range, but it's more of a bull channel. Here's the trading range. This is like what we have now. Rallied for a few bars and then found sellers again, but that's from the moving average. This is a little bit like today. Rally sideways, did not quite get to the moving average. Tried to resume up, but could not get very far. Had to get down to the moving average. Sometimes it just goes up and never hits the moving average. Again, this is channeling up, not sideways. Today's sideways. So I think the odds are we're going to have a hard time going very far up from here. Bulls want to get a gap. They know the bears will probably sell the 11 high. So the bulls are trying to get a gap up here, and they're trying to trap the bears. So they'd like to rally for several points and create a gap and force the bears to buy back their shorts higher. More likely, this is going to be a magnet, a final flag, and that the upside will be limited. Let me see if we go up for a measured move where that would take us. Market's getting close to the all-time high. That gets us near it. Right now, I think we will not get there. I think that this breakout will fail, and that will go more sideways, continue the trading range. What about selling at the market at the 11 high and 1 point higher, 2 points higher? I think traders will probably be able to avoid a loss. I'm not sure that it's worth doing. What are the chances that we just start to do this, get gaps and gaps, and the bears just keep getting killed? I would say 20% chance. Again, today we went sideways. Here we were in a bull channel, and today we were sideways. So today is not nearly as strong as those other days. So I think the best the bulls get is a few bars up and then sideways again. What do the bulls do? Right, it's still always in long, but I think they're buying pullbacks. And while it's possible we can get the measured move up, and this is possibly a buy the close, I don't know. I'm not sure that it's worth buying up here. I still think it's probably better to buy a pullback. And for the bears, I think we're always in long. I think we're going to get sideways to down to the moving average. But I'd rather be buying pullbacks for scalps than selling rallies for scalps. And you can argue higher high, major trend reversal, bull trend, bear breakout, higher high, but tighten enough bull channel. Look at the size of the pullback since 14. 1 bar, right? 1 bar, 1 tick. Chances are, if we get a reversal here, the best the bears will get is a 1 or 2 bar pullback, and they'll need at least a micro double top. So the downside risk is not very good. It's a low probability major trend reversal. Too many bars in a very tight channel. The bears probably needed to go sideways for 3, 4, or 5 bars before they have a chance of some kind of reversal. Remember, I said that once we get the breakout of the first 18 bars, 90% chance we've seen, here we got a breakout above the first hour and a half range. So 90% chance we will not fall below the low of 1. So a very small chance of a big sell-off from here. That does not mean we trend up all day. I still think we're going to get down to the moving average, and that we probably will not go much further up. Here we broke to the upside, rallied for several points, but got down to the moving average. And so I think that what we're doing is similar to this. Limit order bears, some sold the 11 high and tried to sell more 1 point higher. Others are simply trying to sell 1 or 2 points above the 11 high. But the bears, if they're doing that, they're only looking for scalps. Only a 1 tick pullback here. Maybe it's 2 ticks. But in any case, the pullbacks have been small for the past 15 bars. So not great shorting yet. Still buy the close. Not much downside risk, because the best the bears probably will get is sideways for a bar or two. Similar to buying closes here. Not much downside risk. Not necessarily we're going to go up very far, but it means that we're probably not going to go down without going sideways for a few bars. Limit order bears probably will make money. The gap above 11 probably will close. But I still think it's better to be looking to buy a pullback than selling right here. And pullback, I think I'd like to buy near the moving average. Limit order bears probably will make money, but probably buyers around the moving average, which will be around the bottom of the channel, so small spike, and then channel, and the breakout point, the 22 high, so probably buyers somewhere a little bit lower. Can you buy right here? First pullback in 13 or 14 bars. The open of the day, the moving average is an important magnet, and I think the odds are we're going to get there. So I would rather look to buy closer or at the moving average than buying at the 30 low, even though we have only 1 pullback bar over here on 18 in the past 15 bars or so. So right now we have about a 14 bar bull micro channel, but I think the odds are the market has to get down to the moving average. You can get there sideways or down. Is there a lot of risk buying here and putting a stop below, let's say 15, and buying more at the moving average? I think that's probably okay, right? I think the downside risk is not small, is not big, despite a higher high major trend reversal. For 32 bars, they've been buying above the average price, and that's a sign of eager bulls. So they probably will be happy to buy at the average price. Buy or sell above 32. Well, we have a gap, 11 high and 32 low, but I still think limit order bears will make money. So I would not buy above 32. Probably sellers above 32, sellers above 30. Getting very close to the all-time high. Probably sellers above 30. We have that gap. That increases the chances that we'll have a small pullback bull trend, but I still think more likely we'll have to get sideways to down to the moving average. Bulls hoping for a wedge. This is an example of gaps, but even with the gaps, we still got down to the moving average. I am currently flat. I'm not opposed to selling here. I don't want to buy again until we get closer to the moving average. want to make a point about ticks here. We have a gap up and we're rallying. Here's ticks. Okay. What's important here is this red line is the zero line for ticks. And the ticks, even though we're going sideways here, the ticks are staying above zero. And that is a sign of bullishness. The ticks, the 3,000 stocks on the New York Stock Exchange, about 3,000 stocks. If on the last trade a stock goes up, that makes the tick of 1. And of the 3,000 stocks, let's say 2,000 went up on their last trade and 1,000 went down. That means the net ticks would be 1,000. Over the past couple of hours, the ticks have never fallen below zero. That means over the past couple of hours, on average, more stocks have traded up on their last trade than down. Even though the stock market was sideways, more stocks are going up, and that's a sign of pretty good buying pressure, and it makes it hard to make money as a bear. So sideways market, but ticks holding above zero, strong ticks. Usually difficult to make money as a bear. Usually the market's going to try to go higher. We're getting sucked up to that all-time high. Downside risk, what about the wedge? Strong bull trends are always forming wedges, and it's irrelevant. What's important here is we're in a small pullback bull trend. So I think it's only worth buying, but it's a little bit late to buy. I'd rather buy at the moving average. So right now I'm getting trapped out. So what happens up here? Well, the ticks are so hot, the ticks are so strong, I think you cannot sell. But I'm stuck right now. I want to buy at the moving average. So right now I'm trapped out. A bigger bar, so I'll buy climax, but no top yet. Ticks still strong above the zero line for the past couple of hours. Very hard to make money if most stocks are going up. Buy climax might go sideways here a little bit, but look at the size of the pullbacks. A couple ticks, one tick. Even with limit orders, it's hard to make money selling. Small buy climax, but it's still a buy climax. It's trying to get a bull breakout above a bull channel. We have an II. We have a magnet below. We got the resistance of the all-time high, but it's still a very small pullback bull trend, and therefore, I think not worth selling. And to buy, I still think we're going to get to the moving average, so I'm not going to buy up here. I'm going to wait. Looks like we'll probably go sideways and down here. Since this is so extreme, it's fairly unusual to get this much buying without a pullback. There's an increased risk of a sharp pullback. Also, when you have a small pullback bull trend day, and we have one here, there's usually a 50% bigger pullback or 100% bigger pullback sometime after 10:30 or 11. Biggest pullback was here, but it really became a small pullback bull trend day starting around bar 14. And the biggest pullback since bar 14 is here, 6 ticks. Right now we have 8 ticks. So I'd say 8 ticks is the biggest pullback. So that means 50% to 100% means 12 to 16 ticks. We'll probably get a 12 to 16 tick pullback at some point before the end of the day. I don't know if it's going to come from here or if we go higher and then get it, but probably about a 70% chance we're going to get a bigger pullback, at least a 12 tick 3-point pullback before the close. And that will make bears more willing to sell above bars, but it's just, I think, really difficult to make money when it's in a small pullback bull trend like this. It's difficult to make money selling. And I don't want to be buying up here. I want to be buying closer to the moving average. So right now I'm trapped out. This is the point I was making, that if you have a small pullback bull trend, there's a high probability, 75% chance, you're going to get a pullback that is 50 to 75%, 50 to 100% bigger than the biggest prior pullback. This entire rally, the small pullback bull trend began here, and the biggest pullback was only 6 ticks, and that meant 75% chance there'd be a pullback that was 50 to 100% bigger, which means 9 to 12 ticks. Today, in this day, did not happen, right? Did not get the bigger pullback. So this is that 25% of the time when it just remains small pullback bull trend all day. Small pullback bull trend, 75% of the time you get a bigger pullback, and here we got a pretty big pullback at the end of the day. Here it does not look like a pullback, but it is, and it's about 50% bigger than the biggest prior pullback. Hard to make money selling in a small pullback bull trend. It's hard to make money selling in a small pullback bull trend, even with limit orders. I'm just highlighting the gaps. Sometimes you get a little bit of overlap and it's a negative gap, but a gap here, there was a gap here also. And because the point of these gaps is if you sell this high and you sell more 1 point higher, it has to fall below this high to make money, and it does not. If you sell this high and sell more higher, it has to fall below this high to make money, and it does not. If you sell this high and 1 point higher, it has to fall below this high to make money, but it does not. And because it does not, the bears who sell have to buy back their shorts. They keep losing, and the market just keeps going higher. On these small pullback bull trend days, when you get that bigger pullback, today should be 3 or 4 points, like 75% chance traders are going to buy it. Only 25% chance you'll get a reversal down. Minimum target is here. Remember, the biggest pullback so far is 8 ticks. Odds are we'll get a 50% to 100% bigger pullback, so that makes this the target, minimum target right there. That's 3 points down. $12 ticks, and might get 4 points down, but 75% chance bulls will buy somewhere between here and here. That's assuming the pullback has begun. It might not have. We may go a little bit higher and then get a 3 or 4 point pullback. So this is the buy zone, right? 3 to 4 points down. We're getting near the moving average, but the math is that we'll get a 3 point pullback, not a 2 point pullback. I think traders can buy for any reason, like at the moving average, but they'll probably get a chance to buy a 3 point pullback. If it's going to fall 12 ticks, traders will start buying at 11 ticks because it has to fall. If it falls 12 ticks and they place a limit order at 12 ticks, they probably will not get filled. everyone knows it's a strong bull trend day, but old timers know the odds are we're going to get a bigger pullback, and that makes traders a little bit hesitant to buy. You can call this a triangle. It's a high 3, high 1, high 2, high 3. And I think it's okay to buy. You probably need a wider stop, like a little bit more than 4 points down, because there is a 75% chance we're going to get a 3 or 4 point pullback. So if you're buying up here, you want a stop a little bit bigger than a 4 point pullback. The bears want a break below the triangle and a measured move down, which would be a 4 point pullback. A lot of bulls do not want to buy until we at least touch the moving average. And now that we're running out of time, we're after 11 o'clock, traders know there's typically a bigger pullback when you have a small pullback bull trend. So that's another reason why bulls will be hesitant to buy, because they know the odds are we're going down here or here, somewhere in here before the end of the day. For the bears selling, since 75% chance we're going to fall 12 ticks, they have that means if they're selling and it falls exactly 12 ticks, they have a limit order to get out. They have to get out at 11 ticks. That means they have to sell at least 7 ticks down or higher to make money. So in other words, they have to sell 5 ticks above that green line or higher, because they know the market might stop going down at that green line, and they need at least 5 ticks down to make a profit with a limit order. I want to say something about Equifax. In the United States, there are 3 major credit reporting companies, and Equifax is one of the 3. And you probably heard that they did not have good security on their computers, and somebody was able to hack in and steal approximately 140 million accounts. And that is probably just about every American who has credit cards or bank accounts. So someone has stolen about every American's social security number, bank account numbers, addresses, names, all kinds of data. And that's going to be a problem. You can argue that, well, at best, maybe 1 million of the people will get problems with identity theft, and 1 million out of 130 million, that's not a big risk, but it is a risk, and I don't have an answer on what to do. And you can see the reaction. That's the monthly chart. Here's the daily chart. It gapped down on Friday, and it continued to sell off today, as traders believe that it's a big problem. I would not be surprised if Equifax went out of business. It's such an egregious, such a horrible mistake on their part that you have to assume they're going to be sued by thousands, tens of thousands of people. If someone steals 140 million social security numbers, you know they are going to sell those social security numbers to thieves all over the world. And I think the going rate now is $30. So the thieves will probably sell the social security numbers for $30 each. And the result is you'll have lots of little thieves all over the world taking credit cards out in your name, trying to withdraw money from your bank accounts. If they get a traffic ticket, they'll have a fake ID with your driver's license, and you'll get a notice in the mail that you got a speeding ticket, or reckless driving, or DUI or something, and you'll have to go to court and prove that it was not you. In any case, I think it's an extreme problem for Equifax. Obviously I'm an American citizen, and the odds are high that I'm among the 140 million people. And if you're an American citizen, the odds are high you're among the 140 million people as well. So a whole bunch of us, on a percentage basis, it's not big, right? Even if 1 million of us get robbed and suffer identity theft, it's still less than 1%. But if you're in that 1%, it's going to be pretty miserable. In any case, I personally hope they go out of business. I think there's kind of a sacred trust that they have in taking our Social Security numbers. We are trusting them. The country is trusting them to have 100% absolute security, and they clearly did not. And therefore, I think they deserve to go out of business. I think they deserve to get sued out of business, and they deserve to lose all of their equity. When you look at the charts, it's far too early. A big gap down, loss of whatever, 30% of their value. Monthly chart, it looks like down to support. But this is one of those unusual situations in which there's a major fundamental change in the company. And, it could be one of those Shearson-Lehman situations where it just keeps going down and down and down. Personally, I'm annoyed, and you should be mad too, that probably 1 million, maybe millions of people for the next 10 years are going to have to spend hundreds of hours trying to fix the problem created by Equifax. They deserve to be sued. They deserve to lose every penny, and that means they deserve to go out of business. So normally you'd look at this and say it's a strong bull trend, we'll get a double bottom, but this is one of those situations in which fundamentals may be more important than technicals. And I personally would not buy the stock. You can see it touched the moving average and we bounced. This is an interesting game here. Will we get the bigger pullback, or will we run out of time? And instead, will the day just keep rallying all the way up into the close? Here's an example of a day where it touched the moving average and you never got the 50% bigger pullback. Usually this is the exception. This is 25% of the time. 50% of the time, you get the bigger pullback. Here you can see it happened in the final hour, but they still got the bigger pullback, the final 30 minutes or so. It's just one of those double top, tight trading range, lower high, major trend reversals. Well, it might function as one. We have double top 46, 57. I think the biggest thing that is going on is the small pullback bull trend, and we know there's a 75% chance we're going to get a bigger pullback. The bulls have a triangle, 3 legs down, 1, 2, 3, at the moving average, but we have that magnet below, and the odds are we're going to fall 3 points or 4 points before the end of the day. I don't know if it starts here or if we go up one more new high and then it starts, but the odds are we're going to get a bigger pullback. $55 did not touch the moving average, but 58 did. So you have 20 gap bar bulls buying around where we are, taking a chance that even if we do get the deeper pullback, traders will buy it. And that's true. Chances are if we get the deeper pullback, bulls will buy. It's a small pullback bull trend. If the pullback happens in the final, 6 bars of the day, you run out of time for the bulls to buy. But if it happens earlier, they'll buy. Even here, happened near the end of the day, but they still bought the final few bars of the day. too late to sell, or if you're selling, you had to sell at least 5 or 6 ticks above the green line. And to buy, we're in the buy zone, right? But chances are we're going to get a little bit lower, so a lot of bulls will wait to buy around the green line and a little bit lower. For the bulls, 5-tick trap, failed breakout below the bottom of a triangle, but we got to within a tick of the target. There's nothing magical about 50 to 100% bigger. That's just a guideline that I use. Whenever there's a small pullback bull trend, I know there's a 75% chance that the bears will get a bigger pullback later in the day. The bulls are viewing this as a failed breakout below a double bottom, a 20 gap bar buy, and a small pullback bull trend. They're trying to create a good buy signal bar, 60, trying to make the bears buy back the shorts, and hoping that bulls will buy as well. I think a lot of the bears will get out above 60 if it has even a 1-tick bull body because of the 5-tick failure. And for the bulls, if it has a 1-tick bull body, they might buy, but we got 3 bear bars closing on their lows. We still have a magnet below. A lot of bulls will wait to see if we get 2 or 3 consecutive bull bars before buying. Bulls trying to create a bull body on bar 60, and bears are trying to create a bear body. Clearly disappointing for the bears, right? They hit their limit order, 5 ticks below 57. Most of them did not get filled. And for the bulls, they're disappointed as well. They don't want to see 3 bear bars closing on their lows, even if the bodies are small like this. So what do you do 60? If it has a bull body, a lot of the bears, I think, will get out. Some bulls will buy and put a stop, down here, below 4 points down. Others will wait to see if we get 2 or 3 bull bars, and then they'll buy, looking for trend resumption up into the end of the day. You can see we're waiting until the final second to find out whether the bar has a bull or bear body. And obviously it has a doji body. A lot of bulls will not take that buy. They'll wait for either 2 or 3 bull bars or for a micro double bottom, and then they'll buy. The bulls are trying to get one more tick here because they know a lot of bears will allow a 1-tick pullback above 60, but they'll become much more concerned if there's a 2-tick pullback above 60. And a lot of the bears will get out if they have not already gotten out. Bulls trying to get trend resumption up. Small pullback bull trend days, usually 75% of the time you get a pullback that's 50 to 100% bigger than prior pullbacks, and then you get trend resumption up. And the bulls are hoping that this is the start of trend resumption up. Not a very good looking buy. 3 consecutive bear bars and a doji buy signal bar. Why would we be stalling exactly right here? Some of the bears did not get out above 60. And then once it went 2 ticks above 60, they placed a limit order to get out break even, which is 1 tick above 60. And that means you have a lot of bears trying to buy exactly at this price. Bulls want a decent buy signal bar. They now have a second buy. 60 is the first one, not a good buy signal bar, plus 3 consecutive bear bars, so a low probability buy. However, this becomes a higher probability buy. This is 2 attempts by the bears to get down to the green line, the 50% bigger pullback. And a lot of the bears will buy back their shorts. If they did not exit above 60, a lot of them will exit above 63. A 5-tick failure. Second time it got to their limit order, did not fill them. And for the bulls, they want to buy, but this bar is getting a little bit big. So a lot of the bulls will will be hesitant to buy above 63. Still always in long, but the middle of a 20 bar very tight range. If I had to be long or short, I'd be long. There's the obvious chance that the market just continues sideways for the rest of the day, and neither the bulls nor the bears make any money. But I think the bears will give up. They have a 5-tick failure and a second 5-tick failure, so I think they have to buy back their shorts above 63. And the bulls, they know the odds are we're going sideways or up, so the odds favor them. But tight trading range did not quite reach the target, and this 63 is forcing bulls to buy fairly high up in the range. Probably buyers below 64, still always in long. We have a second entry buy, 20 gap bar buy, low probability sell. So what do? Best choice is wait. The bulls should not have allowed a second pullback, and certainly a 2-bar pullback below 64. And the bears, I think most of the bears get out above 63, even though it's not a strong buy. I am flat. I did sell below 57. I got out break even. I did not buy above 63. I did not buy below 64. So right now I'm flat, looking to buy. I'm willing to sell if this becomes a lot stronger, but I think it's more likely this is going to be what I said, a small pullback bull trend day, having a 50 to 100% bigger pullback at the end of the day, and the reversal attempt fails 75% of the time. So this bear reversal attempt probably will fail. The bulls got their pullback 50% bigger than the biggest prior pullback, and that would make this a reasonable buy above 67, looking for a swing up into the close. If 67 is closing on its high, maybe a 1-tick tail on top. The bears are hoping this is an endless pullback and that all the reversals up fail and we just keep channeling lower and lower. But the probability favors the bulls if they get a decent buy signal bar, 67. I think this becomes interesting. Let's say the bulls get a decent buy signal bar and they buy above 67 and it goes 1 tick above 67 and then goes outside down below 67. That in general 50-50 chance the bear breakout fails and it reverses back up. In this circumstance, because the bulls had 3 attempts up, if it does trigger the 3rd attempt and goes above 67 and then goes down below 67, I think better than a 50-50 chance will fall for a measured move down. Okay, 1-tick tail did not close on its high. It would be better if it closed on its high, but still, I think it's difficult to hold short when I think we're still always in long, and the bear bars, 3 bear bars here, bear bar here, and then bear bar here, are not having good follow through. Plus, now we've hit the minimum objective of a 50% bigger pullback. Here's the biggest pullback. I guess this is 9. Let me see. No, after it began. Let me get this. Okay, the small pullback bull trend began here. And the biggest pullback after it began, 6 ticks here, 8 ticks here. This is 50% bigger, 12 ticks. Can you be holding a short for a swing down? I would not. We do not have a convincing top. We have a double top, lower high major trend reversal, but not enough bars. The whole thing is only about 15 bars. And in general, I think you need a bigger pattern to get a big move down. So what about bull scalpers versus bull swing traders? I think it's an okay swing, looking for trend resumption up to the end of the day. I think it's less good as a scalp. Look at the last series of buy signals, buying above 45, above 47, above 52, above 54, above 60, above 62. So that's about 6 consecutive buy signals, every one being a loser. That makes the probability of a scalp buying above 67 low. But I do think it's an okay swing buy, because when you have these small pullback bull trend days, and you get that bigger pullback at the end of the day, here, the bulls kept trying, this is similar to today, the bulls kept trying to get a reversal up, and they did not get very far. But at least they got 2 small legs up. They can get out on the second reversal down. Here, trend resumption up at the end of the day. Not much trend resumption up. Well, there was a lot of time left in the day, but even here, the bulls got trend resumption up and a buy the close finish. Bigger pullback, strong rally. This is about an hour earlier in the day than what we have today. I would get out of shorts above 67. I think it's an okay swing buy. Higher probability, you wait for a couple more bars to see if we get 3 consecutive bull bars. That's the swing buy. Bear channel. The bulls need to get above lower highs to make the bears give up. I think most bears should be out. I would not be holding short here. We're still always in long. And we got a decent bull bar 63, another bull bar 67. And if we start breaking above these lower highs, that would increase the chance that we'll get a swing up here. Let me zoom in a little bit on this. Bulls want buy the close. They have 2 problems. One is we're in a tight trading range, tight bear channel, and it's a little bit early for a buy the close rally to make it to the end of the day. I think the current bar is important. Will the bulls get another consecutive bull bar, or will we get a bear bar? If we get another bull bar, especially one with a 3 or 4 tick body, then we're probably going to get a trend resumption up to a new all-time high. If we get a bear body, a lot of the bulls will get out below 70. To me, it depends on what the body looks like. If it's a 1-tick bear body, a lot of the bulls will stay long, taking a chance that we'll get at least a second leg up. They view this as a wedge bull flag, a 20 gap bar buy. Here's the 20 gap bar buy. 3 bear bars, the bulls wait for a second entry buy. They got a second entry buy 63, but a big bull bar forcing them to buy pretty high. So not ideal. And we broke below the double bottom, 60, 63, and we reversed up 67. Not strongly bullish, but bullish enough, so I think it's an okay swing. the management in PowerPoint of these sections, I think, is kind of primitive. You can't just copy and paste. All right, so the bears have a failed breakout. However, a lot of bears will not sell because we broke below the double bottom and now we're breaking above the double top. It's kind of like the daily chart. We have the II. We broke below the bottom of the II, and then today we gapped up and broke above the top of the II. So after the bears have a losing trade, the bulls have a higher probability of a winning trade. And after the bears have a losing trade here, the bulls have a higher probability of a winning trade. So low probability short, you can argue that we're still making pretty much lower highs and lower lows, and therefore an okay swing down. But we got 3 buys here, 1, 2, 3, 2 with decent buy signal bars, and now we have a decent entry bar 69, and we're still always in long, and we have a 20 gap bar buy. All of that, I think, makes this a low probability sell. It weakens the bull case, but it's not, to me, good enough to sell. If we quickly reverse down and break below 67, then I think bears might sell. If we go sideways here and get some kind of a double top, then bears might sell. But I see this as a type of a wedge bull flag, or you can argue bear channel, bull flag, and then a bull breakout. So I think this is more likely a pullback from the 69 breakout than it is a failed breakout and the start of a bear trend. What's the chance of the two possibilities? I don't know, better than 60% chance it's a pullback from the 69 breakout, and maybe less than 40% chance it's a failed breakout and we're going to trend down from here. If we start to get 2 pullback bars or 3 pullback bars, then the probability for the bears goes up. But if it's just 1 bar and just 1 or 2 ticks below 70, and then the bulls get a bull bar and we start to resume up, that would validate this as being trend resumption up, a bull breakout of a bull flag. We've been sideways for 30 bars. So you have to assume the market is pretty neutral, and therefore we're not getting consecutive big bull bars, and we're not getting consecutive big bear bars. We had 3 bear bars here, not very big, a big bear bar here, reversal up, big bear bar here, reversal up. So it's still pretty neutral, and the bears tried on 66 and failed, and now the bulls are trying. Important bar 71. Can the bulls prevent it from being a bear bar? Can they make it a bull bar? And then if they make it a bull bar, can they make 72 a decent bull bar, breaking above at least one more lower high, 57? The bears were unable to get 3 consecutive bear bars, but this is obviously not good for the bulls either. They're still on a swing buy, but they want this thing to get going to the upside. They don't want it to be pulling back for 2 bars, 3 bars. And for the bears, it's still a low probability short, but it's a little bit higher probability now that they have 2 consecutive bear bars. Still slightly more bullish than bearish, but 1 more pullback bar. If 73 goes below 72, then the odds might shift in favor of the bears. This is late enough in the day so that traders can get either I did buy with a stop above 67, which I typically do not do in a tight trading range. And I was disappointed by 70, 71, 72. And after the close of 72, I placed a limit order to get out break even. And I was filled, which is at the 73 high. And whenever I get filled at the high tick on a limit order to get out of a long, I suspect that I did the wrong thing, that I should have stayed long. Normally, if the market is going down, it does not let bulls get out without a loss. So it makes me wonder if we're going to go up here. I'm back to flat. Bears trying to get their reversal. I am flat. I think this is going to be difficult to sell unless we start to sell off pretty sharply. Remember, a new all-time high in a trading range where traders have been selling at every prior high, above this high, this high, this high, this high, this high, this high. So you have sellers up there, you have bulls taking profits. For the bears, it's a wedge. 1, pullback 2, pullback 3. It's a double top, slightly higher high, and an expanding triangle. 1, 2, and then the bears need a reversal for 3. I am not especially bearish. I think the odds are we're going to have a 150 point correction at some point before we go up much higher. But betting that any one of these reversals is going to be the start of that correction is a low probability bet. Theoretically, the stop for the swing bulls was below 67. But I think most get out either below 70 or 71. You buy again above 74? Well, it's not high enough probability for a scalp, but it's okay for a swing. Higher probability to wait to see if we start to go up. But, look at the past 30 bars. We've been in a 2-point range, and the probability is we're not going to go far from, chances are we're not going to get a trend at the end of the day. Really difficult to do anything. Obviously, some stop entry someday eventually is going to work, but when you have 10 stop entries where 1 or 2 worked, it's really a low probability bet. Better to wait for tomorrow. I think really difficult to be holding short for a swing to the double top, lower high major trend reversal. And the bulls, if they did buy, they got stopped out. So, and limit order trading, tricky. Obviously, if bulls bought below and bears sold above, they'd make money. But I think better to wait for tomorrow. First half of the day was fairly predictable and tradable. And then the second half of the day, really difficult to make money. We had a gap up, big gap up, and whenever there's a gap up, there's an increased chance of a trend day. And it's slightly more likely that the trend will be in the direction of the gap. Here we had a gap up, so slightly more likely if there's going to be a trend day, it'll be a bull trend. And then the first bar closed with a decent bull body. That increased the probability of a bull trend. And then the second bar also had a decent bull body. So we're probably always in long, and if we're going to have a trend, that'll be up. And at the close of bar 2, I think the odds were today would either be a bull trend day or a trading range day. The odds of a bear trend day became a lot less with consecutive bull bars on the open. And then we had a third bull bar on 3, but shrinking bodies. And then bar 9, we finally get a pullback. 10 went below 9, but that's a 9-bar bull microchannel. 9 bars without a pullback, probably buyers below 9, and they were. But you can see the bulls simply scalped. It went up 5 ticks exactly, allowing the bulls to scalp out. We have a parabolic wedge with 3, 6, and 11, and it's possible this is the high of the day. But with 9 bars up without a pullback, I think the best the bears will get is a trading range. And they got a pretty good reversal on 14. Odds are they would be at least a second leg down. And they got a small second leg down on 18. and then they tried to go down again on 21 and a third time on 23, and then gave up on 25. So 25 is a give up bar, probably going at least a little bit higher. We have the magnet of the all-time high above, and I don't know that we'll get there. We've had 2 decent bull bars and then about 20 small sideways bars. We might not be able to get up to the all-time high. It turns out we did. It was by the close here. The bar's not all that big. 31, a higher high major trend reversal, but a 10-bar bull microchannel, 15-bar bull microchannel. The bears will probably need at least a micro double top, which they did not get. Then we got some trend resumption up, 34, 35, 36. And then we had that big bar, 39, breaking to a new all-time high by 1 tick and having a big tail on top. That's a bi-climax, and it's a big bar, so it's a bi-vacuum test of resistance, the all-time high. And I did not have a channel line drawn in, but you can see it broke above the bull channel. And then we had a pair of inside bars, and I said I thought we were probably going to go sideways. And we did. We entered a tight trading range, slightly sloped down, but it lasted the rest of the day. And traders can trade with stops if they're looking for swing trades, but very difficult to make money scalping with stops in a tight range, because when you're buying with the stop, you're buying too high up, not enough room up for a profit. When you're selling with the stop, you're usually selling too low down, not enough room below for a profit. So it's a limit order market, and when the range is as tight as this was, it's usually better to wait or to get in and get out pretty quickly when you decide the market is not doing what you thought it would do. We had a 20 gap bar buy, 55, but the bulls just could not get trend resumption up. The bears had a double top lower high major trend reversal, 46, 57, but not really enough bars. When you get that kind of a double top lower high major trend reversal, I like to see 15 or 20 bars in the tight trading range, not 10 or 15. So I thought this was not major. I thought it was minor. And then the bulls had stop entry buys. The bears had stop entry sells. And although, one of the buys was profitable, well, 677 not yet profitable, and one of the sells was profitable, 70. Most of the trades were losers for the stop entry traders. Small pullback bull trend began, bar 15, and 75% chance you're going to get a pullback that's at least 50% bigger than the biggest pullback in the small pullback bull trend. The trend began at 15, and the biggest pullback was here, down to 44, 8 ticks, 75% chance we'll get a 12 tick, 3-point pullback, which we ultimately got over here on 67. The bulls tried to get trend resumption up several times, and so far have been unable to get it. Stop it. Well, let's talk about buy the close, sell the close. One was buy the close. I think we're always in long close of 1, certainly by the close of 2, buy the close all the way up through 8, 9, even 10's probably by the close. And then the bulls got trend resumption up on 25, 26, bad follow through, small bars, buy the close, but probably limit order bears will start selling at the high of 11, maybe a point or 2 higher. On a small pullback bull, I would not sell the 11 high. I would consider selling 1 or 2 points higher, but I'd like to see the bears make money before I start to sell. And the bears did not make money until all the way up here. The bears have sold the all-time high. So buy the close from bar 1 through bar 9 or 10, and then probably buy the close again 27, 28, 29, 30, all the way up until you get that big bar 39, and it never became sell the close. Stop entries above 1, above 2, above 4, above 5, probably all good. Above 10, I don't know. I think the downside risk is small, but we have 5 or 6 small bars. It looks like we're going sideways to the moving average. So if you're buying above 10, stop below 1, and you have to be scaling in lower. Failed breakout for the bears, bar 16, bear breakout 14, failed on 16, probably at least a small second leg down. And the bears got a second leg down. They tried to get a third leg down on 21 and failed. And then we got an II 24, and the bears gave up 25. So we're probably going higher at that point. pullback 29, pullback 32, pullback 35, pullback 38. If you're taking any of those, you need to stop somewhere down here. And then through here, I would not do stop entries. It's a limit order market. I think the bias favors the bulls, although selling above 44, 45, 47, probably okay for a scalp. We should get down to the moving average. And then buying below bars, buying below anything, 52, 60, 67, probably an okay buy scalp. But range very tight makes it very difficult to make money. Limit order traders, the first limit order trade that made sense, probably buying below 9 at the 9 low, maybe selling the 10 high for the parabolic wedge, probably buying below 17, and then buying below 30, buying below 37. Up here, that big bar, 39, buy vacuum test of the all-time high, probably not worth buying until we get closer to the moving average. Limit order bulls who bought one tick above the moving average, 55, made money. And then bulls who bought at or below the moving average made money through here. This is a buy climax. Small pullback bull trend. 75% chance you're going to get at least a couple hours of sideways to down trading within the first 2 hours of tomorrow, starting by the end of the second hour. But we got it right here. So it's not necessary to get it tomorrow because we already have it here. 50% chance we got some attempt at trend resumption up in the first couple of hours, but coming out of a very tight range that lasted 30 bars, 40 bars, the trend resumption up probably will not get very far. Daily chart, 3 pushes up, 1, 2, 3, but the bears need a reversal. Bears probably will sell above the all-time high, and so they'll sell there, they'll scale in higher, betting that even if we go up 20 or 30 points, we'll pull back below that high, which we probably will. This is the daily chart. Question, how should I practice on the weekends and evenings? What I still do, I still scroll through charts. So I just go back to any day and I just go through bar by bar and think about what should I be doing? Is it long? Is it short? If it's long, where's my stop? And where's a reasonable target? If it's short, where's my stop? Where's a reasonable target? And then I look at opens, always in long, should go higher. Should be a buyer at the moving average. This is similar to today, 2 legs down to the moving average. So I spend a lot of time looking at opens, opening reversals, failed breakouts, and then I also spend a lot of time looking at the end of the day. What happens at the end of the day? We're getting trend resumption, we're getting trend reversal. Is it a trading range day? If so, is the open of the day a magnet? Is the market going to try to get down there? So that's, I'm just always looking at charts. I've been doing this 30 years now, more than 30 years, and I still enjoy looking at charts for 2 things. Every now and then I discover something I never realized in 30 years of trading. That's rare at this point. But beyond that, it's practice. It's like anything else. Major League basketball players, baseball players, professional musicians, they all have to practice. And as a trader, I want to keep sharp. Some patterns, you won't see the setup for a month or 2 or 3, and it's easy to forget about it. But if you keep looking at charts, you'll say, oh, that's one of those, or that's one of these. And, it gives me a chance to keep it fresh in my mind. So if I see it starting to unfold during the day, I'm ready to trade it. All right, that was the only question. We finished the day always in long. Trading range after a breakout, slightly more likely we'll have trend resumption up. But once you get 20 bars, here we have 40 bars. Once you get 20 or more bars in our tight trading range, the probability of trend resumption up starts to fall close to 50-50, and the probability of trend reversal down starts to rise up to about 50-50. Daily chart, good looking bull bar, but let's see what follows. We have an FOMC meeting next week. I am assuming tomorrow will not be another big, strong bull trend day. Even if it is like this, a pair of bull bars will soon probably start to go sideways, especially given we have that FOMC report next Wednesday. Okay, hope everybody has a good night.